Welcome back to Reg Talk UK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation. I'm Alex.
And I'm Jamie.
This week, we're taking a deep dive into some really crucial updates from across the UK's financial landscape.
That's right.
We'll be looking at the latest inflation figures and, the intensifying financial squeeze that's hitting households and businesses.
Yeah, it's a persistent issue.
Then we'll unpack the mounting speculation around some significant property tax changes. These could, well, fundamentally reshape the market.
Big potential changes there.
We'll also explore some interesting new features for cash deposits from major UK banks.
Keeping cash accessible.
And finally, what can we really learn from recent financial firm failures, for our own risk and compliance strategies?
Absolutely. It's quite a packed agenda today, all designed, really, to give you the clarity and substance you need to navigate the coming weeks.
Especially with the autumn budget just around the corner.
Exactly. We've sifted through the latest articles, research, data, pulling out those vital nuggets of insight so you don't have to wade through it all yourself.
Great. All right, let's unpack the economic news first, starting with that stubborn beast, inflation. The Consumer Prices Index, CPI, it saw a jump to 3.8% in the 12-month to July 2025. That's up from 3.6% in June.
And the highest rate since January 2024, wasn't it?
It was, yeah. And if you look at the broader CPIH measure, the one including owner-occupiers' housing costs, that also nudged up 4.2% from 4.1%.
So still heading in the wrong direction, basically.
Yeah.
What's really driving this sustained upward pressure?
Well, this is what's fascinating and maybe a bit surprising. The main driver this time wasn't just energy or, broad supply chain issues.
No, what was it then?
It was a huge jump in airfares, a whopping 30.2% increase just between June and July.
30%? Wow.
Yeah. The Office for National Statistics links it directly to the timing of school summer holidays this year. Suggests a real concentrated demand spike.
Right, okay. Seasonal, but still a big impact.
But it's not just holidays. We also saw food and non-alcoholic beverage inflation rise again, fourth consecutive month. It's now 4.9% in July.
That's the highest since February 2024 for food, isn't it?
It is. And this isn't just a blip, Specific things like beef, sugar, chocolate, instant coffee, fruit juices, all saw sharp, persistent price increases.
That sustained rise in food costs, that's what really hits home for people day to day, doesn't it?
It absolutely does. The Resolution Foundation flagged up a really worrying 32% increase in food bank use compared to 2021-22.
32%. That's a stark figure. Shows the real-world impact behind the percentages.
Exactly. We heard stories like Michelle Birkenhead's, who mentioned her weekly shop, maybe £100 a couple of years back, is now costing £150.
It's sobering. We talk about indices, but ultimately these numbers mean families struggling.
And it's not just households, is it? Businesses are feeling the pinch too.
Oh, massively. Peter Kinsella from Lunia Restaurants. He reported his overall costs are up about 9%.
And specific items even more.
Yeah, he said dairy, running it close to 15% higher in just 1 month. And he basically said, there's nothing left to cut anymore.
Oof. That's tough.
Even at the supply end, dairy farmers like Graham Dutton are citing cost pressures on everything.
Yeah.
Things like drought, rising equipment costs. It all feeds through.
So given these compounding pressures, what's the kind of strategic takeaway for retail banking professionals listening? Any relief coming on interest rates?
Well, probably not this year is the short answer. This lingering and pretty broad-based inflation concern means economists are now widely thinking no more interest rate cuts in 2025.
Right. The optimism from earlier has faded a bit then.
It seems so. This sustained pressure, especially from airfares and food, has shifted that outlook. And this has clear implications right across your product suite.
How so?
Well, for mortgage holders facing remortgage decisions, it means potentially higher repayment burdens sticking around for longer.
Okay.
For credit appetite, we're likely to see continued caution from lenders.
And for overall customer financial health?
Vigilance is key, both for individuals and SMEs. This intensifying squeeze means banks really need to stay incredibly proactive about customer affordability, about support.
Especially identifying vulnerable customers early.
Exactly, before problems escalate. It's not just about managing defaults down the line. It's about understanding the deeper resilience, or maybe lack of it, in different customer segments right now.
Okay, so moving on from those immediate pressures of inflation, let's pivot. Let's talk about a major area of potential change, something that could fundamentally reshape the UK's financial landscape.
property tax reforms.
Exactly. The speculation around that. This is particularly critical for anyone involved in lending or real estate. What's sparking all this talk?
Well, there's this big question hanging over the autumn budget, isn't there? How will the government raise revenue?
Especially with economists warning Chancellor Rachel Reeves might need to find as much as $50 billion.
Yeah, to address a projected, $41 billion shortfall in public finances, it's a big hole to fill.
So where might the money come from?
Well, one major area of speculation, and it's getting louder, centers on capital gains tax, CGT. Specifically, on primary residences.
Ending the current exemption.
That's the suggestion. Reports suggest the Treasury is considering ending that exemption for main homes, particularly those above a certain value, maybe around 1.5 million.
And this isn't just media chatter.
Well, significantly, the pensions minister, Torsten Bell, he pointedly declined to rule out such plans when he was pressed on it. That kind of non-denial gives the speculation a lot more weight,
Right. And the implications, if they did that, they'd be pretty profound.
Huge. Higher rate taxpayers could face, a 24% levy on any gain in their home's value?
And basic ratepayers, 18%?
Correct. The Times reported that a 1.5 million threshold could hit around 120,000 homeowners.
With average CGT bills approaching £200,000. That's staggering.
It is. And we're also hearing talk of scrapping stamp duty altogether.
And replacing it with
a national property tax, perhaps on homes worth over, say, £500,000 paid by the seller.
Which could even pave the way to replace council tax eventually.
That's the medium-term speculation, yes.
Yeah.
It would fundamentally alter how property ownership is taxed in the UK. A massive shift.
So for the banking sector, what are the potential impacts? They must be multifaceted.
Oh, absolutely. And potentially quite long-ranging. First off, you could see an initial, maybe short-term, increase in housing supply.
From landlords selling up.
Exactly. Landlords selling buy-to-let properties, maybe trying to get ahead of potentially tougher measures. That could put some downward pressure on prices in certain segments.
But paradoxically,
it could also lead to a rental market squeeze. Fewer rental properties available could mean even higher rents.
Right. And what about CGT on main homes? How does that affect behavior?
Well, it could significantly reduce housing mobility, particularly perhaps for older individuals looking to downsize.
Why is that?
Instead of selling that large family home, they might just choose to stay put to avoid facing a substantial tax bill on the gain, that locked-in effect.
So beyond just house prices, how does this play out for banks directly? What should people be thinking about?
Well, these are significant structural changes, right? They'll influence mortgage demand across the board.
In what ways?
Think about first-time buyers maybe facing higher entry costs if rental options shrink. Think about older borrowers being disincentivized to move. Property valuations become even more critical.
It's understanding customer behavior.
Definitely. Understanding the long-term investment behavior of customers, especially those with buy-to-let portfolios or high-value homes, banks need to anticipate shifts.
So it's more than just tweaking lending criteria.
Much more. It's about anticipating, entirely new client segments potentially emerging or shrinking. Understanding the long-term capital allocation shifts these reforms could trigger.
Interesting. Could it spur demand for other products?
Potentially, yes. Maybe things like equity release as a way for people to access their housing wealth without triggering CGT on a sale. It's definitely one to watch closely.
Okay. Let's shift gears now. Moving to customer-centric innovation. Some interesting news regarding cash access, which is always a hot topic.
Yes, Bank of Scotland and Lloyds Bank, they're launching a new feature in their mobile apps.
Allowing cash deposits via PayPoint locations.
Exactly. Across the UK, it seems like a very smart move, leveraging existing infrastructure.
Tell us how it works.
Okay, so starting from August 26th, customers can generate a unique barcode in their mobile banking app. It's valid for 2 hours.
Right.
Then they just take their cash, notes and coins, to a PayPoint location over 3,000 in Scotland for Bank of Scotland, over 30,000 across the UK for Lloyds Mode. Scan the barcode and make the deposit.
How much can you deposit?
Up to £300 per day with a monthly maximum of £600. And apparently the money typically shows in the account within minutes.
That sounds incredibly convenient, and the accessibility point is huge, isn't it?
It really is. Apparently 99.5% of people in the UK live within 1 mile of a PayPoint site.
Wow. So it effectively turns thousands of local shops into mini bank branches just for deposits. That's a real game changer for many people.
Definitely. As Gabby Collins, the payments director at Bank of Scotland, put it, she said, "With this new innovation, no other UK bank offers as many ways to manage money as Bank of Scotland."
And it's not just deposits, is it? Their app offers quite a lot.
Oh, yeah. The Bank of Scotland app alone has a huge array of features, managing subscriptions, checking credit scores, depositing checks just by taking a picture.
Even a benefit finder.
Yes, to estimate eligible support. It's pretty comprehensive.
So what does this signal for retail banking more broadly?
Well, I think it highlights this ongoing sort of dual drive. On one hand, banks are pushing the boundaries of digital innovation and self-service. But on the other, there's this clear recognition of the need to maintain access to essential cash services, especially for those who might be digitally excluded or just prefer using cash sometimes.
Bridging the gap between digital first and physical access.
Precisely. It's a good example of how traditional banks are adapting to evolving customer needs and the changing branch landscape. It also sets up an interesting competitive dynamic.
Against challenger bank.
Yeah.
Yeah.
Traditional banks leveraging these established physical networks like PayPoint to offer services that might be harder for purely digital challengers to replicate easily.
Right. Okay, finally, let's turn our attention to some recent actions by the Financial Conduct Authority concerning financial firm failures. Always crucial for compliance and risk professionals to understand these cases.
Absolutely. 2 firms have recently entered distress, and they offer some key lessons because the situations are quite different.
Okay, what's the first one?
First, Fernwood Financial Limited. It's a high-cost lending firm. It entered liquidation back on June 27, 2025.
And the key takeaway there.
The really important point, and a significant relief for those affected, is that all loan balances for their current customers have been written off in full.
So customers don't need to make any more payments.
Correct. No further payments needed. It highlights how liquidation often aims to wind down a company and settle debts, and sometimes that means discharging consumer liabilities if the assets aren't there.
Okay, that's Fernwood Financial in liquidation. What's the second case?
That's Waltham Forest Council Employee Credit Union, which traded as Forest Savers.
A credit union?
Yes, a financial cooperative. It entered administration on August 19, 2025, and has now ceased trading.
So administration, not liquidation. What happens here?
Well, the Financial Services Compensation Scheme, the FSCS, is stepping in to protect members' deposits. Their money will be returned, usually within 7 working days.
Okay, so savings are protected.
Yes. But, and this is the critical distinction for you, our listeners' members are specifically advised not to cancel any loan repayments they might have with the credit union.
Ah, so the loans remain active.
Exactly. Those loan agreements remain in place and will be managed by the joint administrators. This is a crucial difference from the Fernwood situation and something that often catches consumers out.
So what's the broader lesson here for banks?
Well, it really underscores the importance of understanding the nuances, the differences between insolvency procedures like liquidation and administration, and how FSCS protection applies or doesn't apply to different products in each scenario.
And communication is key.
Absolutely critical. Clear, precise communication to customers about their obligations, especially when loan repayments are still due, even if their deposits are safe. It avoids confusion and distress.
And on a slightly related note.
Well, it's not a direct regulatory issue for banks, but the recent scrutiny Chancellor Rachel Reeves faced over some errors in parliamentary figures.
Misstatements about unemployment and pensions.
Yes. It just serves as a timely reminder, doesn't it? For all of us, but especially those in risk and compliance, about the absolute paramount importance of accuracy and detail in any public financial communications. Even small data inaccuracies can have a big impact.
A very good point. Okay, so to quickly recap then, we've covered a fair bit of ground this week, pulling out those essential insights for you.
We have. We delved into that persistent rise in inflation, driven notably this time by airfares, but also ongoing food price rises.
And the intensifying financial squeeze on both households and businesses, with the growing expectation now of no immediate interest rate cuts this year.
Then we explored the significant speculation around potential property tax reforms in the autumn budget. Big things like capital gains tax on primary residences, maybe even a national property tax replacing stamp duty.
Changes that could profoundly impact the housing and rental markets, influencing mortgage demand, valuations, mobility, the works, really.
Definitely. And on a more positive, customer-focused note, we looked at Bank of Scotland and Lloyds Bank enhancing convenience and inclusion with those new PayPoint cash deposit features.
Leveraging existing infrastructure alongside their pretty comprehensive mobile app offerings.
And finally, we distinguish between those 2 recent firm failures, Fernwood Financial and Forest Savers, highlighting the critical differences in how loans and deposits are handled under liquidation versus administration. Valuable lessons there for risk and compliance.
Absolutely. These are all, we think, vital insights for staying informed and strategically positioned in UK retail banking today. So as you look at the landscape ahead, as you plan for the coming months, here's a thought perhaps for you to consider.
Given that intensifying financial squeeze on households, the potential for really significant property tax changes, and that ongoing evolution of cash access, how might retail banks, how might your institution need to proactively adjust?
Adjust customer support, lending strategies, maybe even product development.
Yeah, not just to navigate this evolving landscape, but to really serve vulnerable customers effectively and adapt to what could be a fundamentally transformed buy-to-let market. What's potentially the biggest blind spot for your institution right now?
Something to mull over. That's all from us this week. Thanks for listening to Reg Talk UK.
Until next time, stay sharp and stay compliant.